The only way that you can become a consistently profitable trader is to have a trading strategy that has a positive expected outcome. By far, the biggest reason that traders lose is because they don't build a strategy. They run into one of two problems. First off, you might have no strategy at all, which means you will just be taking random trades, meaning some will win, some will lose, but there's no backing to them and there's no way to build a statistical edge. And this random sporadic trading style is not going to let you win. Now, the other problem might be strategy hopping, where you find a good strategy, you come across it, and you trade it for a little bit. But then eventually you start running into losses. And instead of just working through the losses, you just give up on that system entirely, move on to another one, and repeat the same process. Jumping from system to system until eventually you get too frustrated and give up. So it's a lack of strategy that makes traders lose. And it is only a strong trading strategy that can save you from the downfall that most traders run into. So in this video, I'm going to lay out a day trading strategy for you, which will be the only system that you need to start generating profits in the market. Now, this system is going to be a purely price action focused system, which means we won't be using any indicators and all of our attention and focus will be on the charts. Charts are the most direct way to look at the markets because they show us exactly what price is doing without any interference. We will also be keeping things incredibly simple, which means we won't be using any fundamental analysis. So no data, no politics, no economics will come into the picture. This is purely chart work. Now, when we're trading, we are guaranteed to lose some of the trades we take. Because we know that we're going to lose a certain portion of the trades that we take, the best way that we can maintain profitability long term is to actually make more money on the wins than we lose on our losing trades. So that's the approach we're going with in this system. You'll see me tie this in when we get into the actual analysis. So simplicity and a strong balance of those profits and losses is what this system is all about. Let's get to it. The first thing you need to be able to do with this strategy, because it's price action focused, is read the direction of a market. Now, we obviously need to know whether a market is going down or up so that we know whether we should be buying or selling. All right. So we're going to look at structure from a high and low format. We're not going to use trend lines or indicators or anything else. What we are looking for simply when we're looking for trends in a market is the market making lower lows and lower highs, or is the market making higher highs and higher lows? If the market is making lower lows and lower highs, this is a downtrend. And throughout a downtrend, we should only be looking to sell. But if a market is making higher highs and higher lows, like this market here, this is a market where we should only be looking to buy. So to show you how to correctly mark highs and lows in a market, we will start from this point. Now, from here, we've actually formed a low in the market at this level. So this is going to be our low. Then we formed a higher high because the market high here was higher than the previous one. Now, this higher high, when this prints, actually validates this higher low. Because until we actually make a new high over this level, the market could do whatever it wanted to do within this range, and it wouldn't yet be seen as a viable, valid structure point. For this to become validated as a low, we do have to see this new high formed. Following that then, once we formed this high just here at this level, we would then see the formation of a higher low. But this higher low, once again, wouldn't be validated until this region when we got a break. Now, once we break into new highs and print the next higher high, that validates this higher low as the next significant leg in the trend. Now, as long as the market stays above this level from this point onwards, the market is going to continue to be in an uptrend. Of course, it will form new higher lows in the trend, and then the same rule will apply. Providing the market stays above this level, buys will remain valid. Okay. Now, eventually the markets will reverse. We'll discuss this in just one moment, but trending structure and understanding whether we are trending down or up based on the high and low structure of the market is the first and biggest step in this trading system. Being a price action focused system, structure is incredibly important. A question you might be asking is, why am I viewing the structure like this, for example, where I'm seeing these larger movements? And why am I not considering each of these tiny little movements that happen within? Now, it would be incredibly valid to say that there are smaller trends taking place within the larger trend that we're looking at. But in order to keep the market relevant, we should remain at one time frame and view structure as larger waves. So rather than marking up every single small movement within each trending move, We actually just view it as one larger push. Okay, same on the way down. There will be bearish trends happening within, but we just want to see that as one pullback. Same again here. Don't worry about every single intricacy. View it as one individual push. These price action concepts are what we call fractal concepts, which means they work across all time frames. So here, for example, we're looking at the hourly. Now, with this day trading system, you'll see us more so using low time frames like the 10-minute and 5-minute later in the video. But the concepts are exactly the same. We can view structure on the hourly, the same as we could view it on the weekly, the same as we could view it on the 1 minute. It really does not matter which time frames we're looking at. The price action is going to be the same. The concepts that we trade with will be the same. Market trends will eventually come to an end. Uptrends and downtrends cannot last forever. There will be reversals in the market, which we need to understand, because if we don't understand reversals, we'll be trading on the wrong side of the market. And if we do understand reversals, we can turn these into trading opportunities. So taking a look at the price action from this point onwards, we've got a higher high, a higher low, higher high, higher low, higher high. Now you can see at this point just here, we broke through the higher low. Now this would then be a lower low, okay? So this is a point where we've shifted from higher highs and higher lows into a lower low. Now following on from a break into a lower low, we see a lower high, then we see a new lower low, we see a lower high, and so on and so on and so on, okay? You're seeing this trend continue through. So marking the structure from the high, we've got lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So we were in an uptrend, but when we broke the structure into that lower low, that kicked off a new downtrend where we then would, instead of looking to buy, we would be focused on selling. All right. So this is the core component that you need to understand about the markets. It's just this market structure theory. We are only going to be buying in a market that is forming higher highs and higher lows. And we will only be selling in a market that is forming lower lows and lower highs. So that's the theory of market structure. That's the first thing we need to be aware of, the foundation of everything we're going to do. Once we have an idea of the direction the market's going in, whether it's an uptrend or a downtrend, the doors are then open to find actual trading opportunities. And to do this, we're going to use a concept called supply and demand. To explain what supply and demand is real quick, the markets are driven by a battle between buyers and sellers. When there are more people buying than selling, the markets will go up. When there are more people selling than buying, the markets will go down. Now, this generally happens because of demand, okay? So if demand is high for an asset, the market prices will appreciate because people want to buy an asset, they'll be willing to pay more for it. When demand is low for an asset, the markets will go down because prices have to go lower to actually entice people to pay the prices. Think of it like this. If you found a car that you really wanted to buy and it was on the market for $50,000, but the price went up to $55,000, you might buy it anyway because you really want it. Now, if you did like the car, but you weren't massively interested in it and the price was $50,000, you might not want to pay it. But if that price goes down to $40,000 or $35,000, maybe you'll be enticed to actually buy the car now, okay? Pretty much the same exact theory here, we're just looking at different assets. So when the price is going up in the Euro USD market, that just means that people want euros for specific macroeconomic reasons. So when the demand is high, markets will go up. When demand is low, markets will go down. Now, I've explained that to you so that you can understand the theory behind what I'm about to show you, which is supply and demand zones. Following on from the theory of supply and demand that I just explained, I want to show you now how we can translate this over to the charts. This comes in the form of zones. So we have demand zones and we have supply zones. A demand zone is an area of consolidation, which is just an area where the market's gone sideways before a large upward move. A supply zone is the same, an area of consolidation before a large downward move. Demand zones take place in uptrends, supply zones take place in downtrends, and the theory is always to buy from demand and sell from supply. Now, the reason that we see demand zones as a good place to buy from is because if we consider what's happening in this market, the market's going up, that means that people want to buy. The fact that we saw a large push from this consolidation, from this demand zone, shows us that this was seen as a good price to buy from. So we can then assume if the market comes back to this level, traders are going to see this as a discounted price to buy from again. We'll see a new influx of demand and new buying, leading us into new highs. So the concept is to wait for pullbacks into demand zones and buy once the market retests them. Now for supply, we're looking at the opposite. In a market that's moving in a downtrend, there's an excess of supply. So demand is not strong enough, and people who have the asset are going to have to sell it off at a lower price in order to induce people to actually enter the market and encourage people to get on the other side of their trades. So in a downtrend, a supply zone or a consolidation before a large downward move is going to be seen as a premium price to sell from. So if the market's able to get up to here, sellers are going to be happy to sell their assets because they are getting a better price than they would be if they were selling down here. This means if we were seeing the market move in a downtrend, we would wait for a pullback into a supply zone and then sell. Okay, so this is the theory of demand and supply. This ties directly in with market structure, and these demand zones and supply zones are exactly where we're going to be getting into our trades. Here's a real example of a demand zone and how we would plot it on the chart and how we would trade it. So to begin with, we can see the market here is in an uptrend. Okay, we're forming these higher highs and higher lows. So the market is clearly in a phase where we would be looking to buy. Now, from this point onwards, if we wanted to buy this market, we would use demand zones to do that. To mark on a demand zone, we just need a tool that's going to show us a box. I use this rectangle tool, and we just want to mark a consolidation before a large up move. So here we see there's been a large up move. Here we see there was a consolidation. So we had a push up, then the market moved sideways. That's the consolidation. Then we have another push up. So it's this area here that's going to be the demand zone. Now, the rule that I like to use to mark my supply and demand zones is the last candle before the impulse. So an impulse is just a pro-trend movement in the market like this. The last candle before it is just going to be whichever the final consolidation was before we see a push away. Okay, so this one here, we have wicks either side. It's an indecision candle. It's the last candle before the impulse. When the market returns into this demand zone, we would then look to buy as we just stated, because this is seen as a discounted price. We know that buyers are in control of this market, but people might not be happy to buy up here. So this demand zone, which is where lots of buying took place before, is definitely going to be seen as a good price to buy this asset. So once the market returns to this level, we would look to buy. A simple trade example using this would look just like this. We have our stop loss below the zone, we have our entry on the demand zone, and our target would then go up towards the highs. Okay, so towards the next higher high, the previous higher high that was formed, because we know if this market is uptrending, it should continue on through and form a new higher high. So targeting the previous high is a very safe way to get into a trade. As you can see, this trade would have played out for 2.77% in profit, okay, which is obviously a very nice profitable trade to take. Now, moving on to the next move, we had a new higher high form, which would mean we would once again look for a demand zone. If we use our demand zone tool just here, we can mark out this kind of last candle before the impulse. If we'd have bought here, we would have lost the trade. Okay, so let's say we had our stop below. We were looking for a trade up to the highs or further. We would have lost this position because the market traded into the demand, but then just traded all the way through it. However, this loss would have then been a 1% loss. Take a look at the buy we just took. That's a 2.77% win. So after taking these two trades, you're still going to be up 1.77%. You can see how by weighing the risk reward, by winning more on our winning trades than we lose on our losing trades, we stay afloat and we balance those profits and losses very well. Okay. Now, this also leads us on to the next thing, which is by forming this lower low, we have obviously instigated a market reversal. So what we've actually done by forming this low here is take away any opportunity to buy in the future. And we've now instead shifted into selling. Okay. Now, if we take a look at the zone just here, we will see we have a clear supply zone. So now that we formed a lower low, we would use this supply as our selling area. All right. So what we would do is place our sell order on the zone, our stop loss above the high, and then our target down into the recent low, which would be just about here, tackling this low, right? So now you can see this trade is a 2.97% position. Now this highlights the importance and the beauty of the risk to reward system that we've developed. As I've already discussed, I want to make sure that we're winning more on our winning trades than we lose on our losing positions. And over those 3 trades where we had 2 wins and 1 loss, the total net profit coming out at the end would be 4.74%. This is because the wins that we take are almost 3 times bigger than the losses. So even if we're losing half the trades we take, or even more than half the trades we take, we will still be profitable due to the fact that we're making more on our winners than we lose on our losers. It's a very important element of the system, and it's one of the easiest ways that you can get profitable by bringing this in. You'll also notice that those 3 trades that we just took all look very similar. They follow the exact same format, meaning they're easy to consistently apply to the markets. So now the format for our trades is very simple. We are looking to find the trending direction. Obviously, in this instance, it's now bearish because we're forming lower lows and lower highs. Then we want to identify the open supply zones, and we use these supply zones for our selling entries. We put our stops over the high and our targets down into the recent lows. And we just look to rinse and repeat this process until the trend turns on us. Now you can see here, we get a tap in, and on the way through to making a new lower low, we get a 3.58% win. Now we can look for another supply, last candle before the impulse. I'm going to be using this one here. We want to have our selling order on that level. We have our targets down into the low. And then for our stop loss, we always want to make sure our stop loss is clearing any significant highs. So we put our stop loss above this high. Now this, for me, this trade is not a high enough risk reward for me to risk money on. So I'm generally going to be looking for 2.5% or more for a win, just because I don't want to risk $100 to make only $194 back. I want to be looking to make $250 back for every $100 risked. Okay, but this setup is still valid. So let's just see how it plays through. You'll see we get a win there, nice and simple. Because we're just following the trend, it's a very easy way to trade. So again, we can follow the same process using this last candle before the impulse. We can mark out the swing low and we can set up a new position, which is going to be selling from supply, stop above the high, targets down into the low. You can see that this one actually would have returned a bit more profit, but because we didn't put the stop over this high, it was stopped out. Now these wicks are going to happen sometimes and they will lead you to lose trades. But let's just take a look at the performance here. We have a 2.97% win. We have a 3.58% win. We have a potential 1.94% win. And then this one, which could have been a win if I had put my stop a little bit higher, would have been a 1% loss for me in reality. So even then, we are achieving a significant amount of profit. We've made over 7% here between 3 wins and 1 loss, which means we could actually lose 3 or 4 trades in a row and we'd still be up enough profit to pay us thousands of dollars when we're trading with funded capital. And look, eventually the market's going to reverse on you, okay? When it does, you're going to be stopped out of your trade and you will lose a position. But that will just open up the doors to new opportunity where you can start trading the market the other way. So for example, in this market where we've started to see the market making new highs, we could instead now tackle buys. So we could focus on demand zones and we could use our demand zone entries, stop losses below the lows, and we could look for trades to the upside. Okay, so we could look to continue the trend to the upside from this point. As you can see, the trade gets tapped in and we start moving higher because we've shifted the direction now once again. So when the market's in a downtrend, we just trade it for as long as we can and take advantage of as many opportunities as possible. And when the market shifts back into an uptrend, we just look to take advantage of each of the up moves until it once again reverses on us. This is not a system that tries to win every single trade because that's not possible anyway. This is just a system that you can use to take advantage of trending movements while they occur, and by the time the market reverses, you will be out with a nice, healthy profit. Every trader has what we call a risk tolerance, and this is a completely personal thing. Your risk tolerance is how well you can handle taking a losing trade or running through a streak of losses. Some people are completely unfazed by losses, which is great. That's the ideal way to trade. That way you can follow out the statistical edge and you don't need to worry about 1 or 2 or 3 losses because you know you're going to make money long term. But for other people with lower risk tolerances, you might, even though you know a system works, have a hard time holding out through 2 or 3 losing trades in a row. So if you want to minimize the losing streaks, there is something you can do, a little simple tip. I'm going to show it you now. So if we lead back to this setup that we looked at previously, we see the market came into a supply zone after forming a lower low, and then we had a new sell-off. Now, if you want to confirm that these sell-offs are indeed very likely to happen, you can use what we call low time frame structure confirmation. So I actually call this the standard confirmation. It's just a completely boring name I gave to it. What it is structural confirmation or a change in the market structure that looks like this. So in a downtrend, we want to see a market shift from higher highs and higher lows into lower lows, and then we look to sell the lower high. So in the standard confirmation setup, we want to see this happen, and then we want to sell from this area here. Okay. Now, if we consider this is on the 10-minute time frame, the trend we're currently looking at, and the market structure shifts to the downside are happening on the 10-minute time frame, The whole setup, the supply zone, everything's formed on the 10-minute time frame. So what we would do from this point is once the market approaches the supply zone, we would go down to a lower time frame. So for example, let's go down to the 2-minute, okay? Now by going down to the 2-minute time frame, we now get a deeper insight into the 2-minute trend, the smaller trend within. To mark out this 2-minute trend, we've got a low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, equal low. Then we have this higher high just here. From that point, we failed to make any new highs. And instead, we actually came down and broke into new lows, okay? So this is the change in the trend. This is the first indication that we're shifting into lower lows. So this is that standard confirmation that we just mentioned, right? If you remember what we said, we want to see that shift, then we want to sell the pullback. That's the selling point, which in this instance would be the pullback into this supply. So we have a supply zone just here. It's that last candle before the impulse to the downside. That would be where we want to sell the market. So we would place our selling order on that zone. Our stop loss would go above the high, and then our target would go down into the low, right? So that would be our target. Now, if we allow this trade to play out, you'll see we trade back into that supply. Then we get the sell-off all the way down to our target. So what we've actually done here is use market structure to make sure the lower time frame agrees with the higher time frame. That 10-minute time frame, which in this instance for day trading would be a higher time frame, was bearish. Now we've actually used the 2-minute trend to see that the 2-minute time frame has also agreed that it is bearish, which means if we sell now, we have full agreement across all time frames, meaning we have the highest probability setup. We essentially use confirmation in the form of low time frame structure to validate the trade and tell us, yep, this trade is good to go. If you use this format, you are going to lose less trades, and the trades you do take will be bigger. You can see we were actually able to dial the stop loss in because we were trading from confirmed structure. So we can put our stop above this high instead of having to put it all the way above the previous high. That means that I believe this was a 3.58% trade before. This would now be a 4.76% trade. So we make around 1.2% more just by following this format. However, do be warned, you have to kind of pick your poison here. While you will avoid a lot more losses, you're also going to take a lot less trades. If we consider the example previous to this, right, we had a trade into this supply. The confirmation didn't happen here. So this would be a missed opportunity. So the 2.97% you made there, that just wouldn't exist. You'd have missed that. So if you're a trader with a good mindset and reasonable risk aversion, and you don't mind taking losing trades or losing streaks because you know the statistical advantage will make you money long term, then I would just trade with the normal sell limits on the zones as we mentioned. But if you're a trader who gets a little bit more stressed out about losses and you want to minimize the chance of running into losing trades, this is a great way to do that. But it will mean that you are going to miss some setups that otherwise you would have caught. So in order to win as a trader, we need to have a strategy, something we can consistently follow, a set of rules and a process that we can apply every single time we come to the charts. And all of the trades we take should look similar. We should be able to explain the exact concepts and the exact reasons behind every trade. Because if our trades come under the confines of a strategy and a system, it means they are repeatable, which means it's easy to stay consistent and we can use the statistical advantage of winning more on our winners than we lose on our losers to make money long term. So some final notes is this system is only going to win around 50% of the time. Sometimes the markets will get into a choppy range and you will be stopped out 2, 3, 4, or 5 times in a row. It only works in trending markets, but fortunately the markets do trend quite a lot of the time. And when they do, multiple opportunities will present themselves, as you've just seen, so we can take advantage of the markets throughout every step of a trend. This strategy, along with any other trading strategy, will not give you trades every single day. Sometimes you will be waiting for a few days, maybe even a week or two, where there are no viable setups for you. So I want you to remember that so you don't get impatient, because if you do just wait for the setups to form, you will make money long term. If we think back to the start of this video, it's messing up your application of the system, jumping from strategy to strategy and all of this other stuff that actually causes you to take the losses and lose control of your trading. So I've just given you a crazy amount of information here, but there's still a lot more to learn. So now you've got two options. Number one, head over to my YouTube channel and start digging into the hundreds of free videos that I've got. I teach so many different market concepts in incredible detail. These videos alone will give you massive amounts of information that you can use to become profitable. And number two, if you like what you see and you want to go deeper with this, you want to get all of my trades, my personal priority support, daily analysis videos, and my full 30-hour trading course teaching you everything you need to know about risk management, macroeconomics, technical analysis, trading plans, backtesting, journaling, you name it, then click the top link in the description and that will take you through to that. You'll be able to see some reviews, some results, because this stuff really works. That's the fastest way to get winning. But if you don't want to do that just yet, check out this YouTube video. This is a great place to go next. We'll build upon the foundations of what we've already discussed in this video. So I hope you've enjoyed it. I hope you put this strategy to the test in the markets. Thank you for watching, and I'll see you in the next one.